All right, welcome to another episode of Asset Coach and Tax Strategist. And here may be another episode that I get a little bit of hate. Um, and that's okay. I won't cry too long. But all seriousness, this is what I feel like to be somewhat of a controversial topic, just because it is the opposite of what a lot of us hear about with regards to mortgages and yeah, go buy a house because you get a big tax benefit and all this fun stuff. And the reality is that's not necessarily 100% of the truth. So like what I always try to do is let's just let the numbers speak for themselves. And we gotta question when we get a tax benefit, when there's a dangled carrot, what's behind that dangled carrot? What's the motivation? And of course, if the IRS or the government giveth, they also have a way to taketh away. They're not in the business of giving away tax revenue. It's just not what they do, right? So what we're going to do today is dive into this. Now, I'm not giving you any investment advice or tax advice or telling you not to do a mortgage or anything like that. In fact, what I'm going to do, and this is specifically to my business owner viewers. So if you are a subscriber and you're a business owner, awesome. Forward this to all your other business owners. Okay. If you're not a business owner, that's okay. What is being communicated here is still valuable information for you, especially if you do have some additional liquid assets or various aspects. And as I go through this will make a lot more sense what I'm saying right here. This is kind of my housekeeping disclaimer, right? If you like this content, give me a thumbs up. If you don't like it, then yeah, feel free to give me a thumbs up and put it in the comments. Bob, I don't like your content, but give me a thumbs up. That would be great. And let's go ahead and dive into this topic here. All right. It's titled Mortgage Hoax. Okay. Now, what I am saying is this is a personal finance. Okay. This is your private residence. This is your personal residence. This is not referring to real estate as a whole. Just when you are renting or someone says, hey, you need to go buy a house because you get tax benefits. Okay. That's what this is. My response always is, well, let's look at the numbers and see. It doesn't make sense. So we're going to dive into a whole bunch of numbers. We're going to get geeky and nerdy. Again, this is my opinion of how I approach the numbers. There's probably going to be a ton of other opinions. Now, am I also saying that it's better to rent than it is to buy a house? I don't know what your situation is. I would not go into the largest debt in your life to not rent and to do this, right? So now you're handcuffed, you're a slave, so to speak, to your house, and you have to do certain things because now you have this house. And also because if someone said, or your CPA said, do this because you're going to get a tax benefit, that may not be accurate advice either. Okay. So this is not a conversation, is buying a house better than renting or vice versa? That's not it. This is just, should we look at mortgages and a private residence numbers, writing off the interest from our mortgage as a tax strategy or as a reason we should get a mortgage and go into hundreds of thousands of dollars of debt? All right. Enough of that. Let's dive into this. Holy cow. I told you there's going to be a lot of numbers. So what we're going to try to do is take one bite at a time. Okay. So this is the full traditional calculator for 500,000 of loan amount. There's interest, right? So we're looking at our interest of 3.25, which is not what current interest rates are like. This is why I'm using a lower interest rate, because if I use a higher interest rate, my numbers are going to be higher. So I wanted to be a little more conservative as to what the last decade was like interest rate wise. And then I'm just showing that, hey, I bought this house in July of this year, right? right? Again, interest rates aren't reflecting of that. I know that this is for illustrated purposes only, not for complete accuracy as when interest rates were when a house was purchased, okay? I want to start from the very beginning of the year that I'm talking about this and moving forward to this overall process. Now, here's the payments. The principal and interest does not include escrow, insurance, taxes, or anything like that. Those are added expenses. I'm just putting this just a mortgage loan interest and principal. Okay. So 30-year loan, so 360 months. And here's the total interest. If you were to stay in this one 30-year loan at 3.25 over 30 years, making your basic principal and interest payments, your total interest would be $283,371.37. Okay. So there you are. That is the basics of what we're talking about. That's our baseline. Now, let's look at here. What am I considering? Well, we work with a lot of high income earners. And so a lot of our clients are in a 37% tax bracket. I'm only talking about Fed. If you're from another state or in a state, which we're all probably in a state if we're in the United States, but I'm not looking at the taxes or the income taxes on that particular state. Okay, I'm not looking at any of that. All right. The other thing is we're also looking at the income needed. Okay, that income needed is for the net benefit coming out of your checking account, which is the principal and interest of $2,176.02 or 3 cents. Okay. This is based on 37%. This is your gross income that needs to go into your checking account to pay taxes, which your annual is 41,000 in income, and here's your total income tax. This is the taxes on the 41,000 annual. Okay, with me so far. All right. So just trying to, again, we're being told that this is a great tax strategy. So I want to make sure that we go through the numbers from that perspective. Now, the tax savings on the percentage, this comes to right here. This is the interest on the first year's mortgage. Now, remember, this is a amortization schedule, which means your very first payment, your very first monthly payment, your interest is going to be higher than it ever will be in the rest of the amortization schedule. To the very last payment will be the least amount of interest, and the principal will flop. So your very first payment is going to, on the principal, is going to be very small in that first payment, but your last payment is going to be greater on the principal versus the very first. Okay, so that's the amortization schedule. Okay, so when we multiply this interest, annual interest, which is right here. So let me back up here. The annual interest is 16,101 times 37%, right? Times 37% gives us this tax on the interest, tax savings on the interest. Okay. So those are the numbers. That is what the CPAs are saying. You can write this off and there you go. There's your tax savings. You may not have known that. You may have just said, oh, okay, cool. Oh, I get to write off $16,000, but you don't necessarily know what it remains to you as an actual dollar amount. Well, when we take our income tax amount, the amount that we need to pay our monthly mortgage payment, principal and interest after taxes, the government gets $9,378.19 more than your 59.57 savings. Okay. All I did was subtract the 59.57 from the 15,335, and this is what the government walks away with. Okay. And when I say government, what I mean is that they've made more taxes on the interest or on the income needed. Okay. This is why I'm talking about this for our business owner clients, because if we don't have a mortgage, which we're going to talk about, if we don't have a mortgage, guess what? I don't need this money to come to my checking account. I can shift this money into other tax strategies in from my business. And if you're doing a mortgage as a tax strategy, I just debunked this hoax. You're not winning. Okay. Yes, you are getting a deduction. So I'm not saying that is not happening. It's just not as much as what you're paying due to the amount of income you need to pay for your mortgage. Okay. Now you would still need this income if your rent was this amount. So that's why I'm not having a conversation of should I rent or should I have a mortgage? Okay. That's not this debate. Okay. What this debate is the numbers of if I'm a business owner and I don't have a mortgage, meaning if I pay off my mortgage, that 41,000 in this example, I don't need as income to come to my checking account to pay for my mortgage. So I can do other tax strategies. This cash flow belongs in other assets. Okay. So that's what the conversation is going to be like. And so here is a breakdown on an annual basis of the amortization schedule from year 1 to year 30. And here's the total. Boom. There's your total. Rock on. And here's your total tax savings. 104,000, Bob. That's a lot of money over 30 years. Yes. But what we're also not considering is inflation and the devaluation of what this tax savings means. But look at here. The tax savings is doing what? It's going down. Why? Because of the amortization schedule. You're paying less interest. Okay. Now, the funny thing is that what happens when interest rates go down? The first thing we want to do is refinance our mortgage to lower our payment. Well, what do? We're now lowering our tax savings. Okay. So again, do not do this as a tax strategy. Do this because you don't want money to go away into a rent and never have that, but understand that there are costs associated with this. And if you're a business owner, we can put it together a strategy to where we can pay this off sooner. So let's talk about what that looks like. Okay, so here is the tax planning strategy. So out of this tax savings, what we want to do is we want to look at, okay, if we did some strategic planning and we had $111,000 of tax savings in a strategic tax plan. Okay, so again, we're not going to go to full on numbers of how we got this number. There's some other strategies and some other things that we did that equated to $111,000 of tax savings. Okay, this is assuming that you're in a certain, generating a certain income to be in a 37% tax bracket. Then what we do is we shift this 111,000, we put 90% into an asset at 5% over 4 years. What happens to the other 10%? Leave it in liquidity, leave it in cash. Okay. Whatever. We can do the whole 100% if we want to, but I'm just showing 5% of the 90% of the 111. So that's $99,900. Okay. That is going in at 5% rate of return over 5 years. And the compound interest is $552,000. Okay. And we're doing this year over year. So that's why this looks like it, because we're doing this strategy year over year. Okay. So we're at $552,000, but not this whole 111, right? We're doing 90% of it. So it's the $99,900 over 5 years gets us to the $552,000. All right. Now, what we're going to do is we're going to take 300,000 of it, or 54%, to pay down the mortgage. That's what the next slides are going to show. Okay. So we built up this $552,000. We're only going to use 54% of it just in this idea, this strategy. Okay. We can decide if we want to do more later on, but I'm just showing you a steps. Okay. And so here's our 300,000 in year 5. Look what happens. Look what happens. This is so amazing. Watch this. Okay. Watch this. Oh my goodness. I love this. So I'm going to highlight this and look what happens. The 300,000 goes in. Here's our annual interest in that year. Look what happens to the interest the following year. It drops significantly, doesn't it? By 10 grand. $10,300. Okay. That's a big savings. Okay. So what do we do? What do we do with that? Well, we could do one of two things. Some people, what they like to do is do a refinance and bring their scheduled payment down. You can do that. But there's costs associated with that. So it really would depend on your situation, the cost of the refinance of the remaining balance, which is 146,000. right? That's the remaining balance. What else could we do? Well, if we did refinance it, would we be in a higher interest or lower interest, right? We may just leave it alone, right? There's options. That's the key, is that we have options. What do we want to do? Okay. Now, what's interesting about this step is that as we do this, we are now creating savings that we can actually shift those savings, those dollars, into the other assets, right? And it could be in the same asset that we took the 300,000 out of. Okay. So there's options, I guess, is the point. And this conversation is not talking about all those options. It's just talking about the numbers of here, what it looks like. So imagine in year 5, we're able to all of a sudden take 300,000. And remember, this is from tax planning, strategic tax planning. So this is money that would have normally gone to the IRS and state or whatever tax bodies based on legitimate tax planning strategies using the IRS tax code and the legal system to structure the right type of plan as a business owner to create that tax savings. That tax savings, a percentage of it goes into a separate asset, compounding at 5% over 5 years. We take a withdrawal out of that and we put it into here to pay down. Now what we do is we take a look at the last 2 years, and then what happens is that we're still having that money compound, right? So we take the last amount of what is owed on the mortgage, the about 145,000. We throw this into here. We pay this off all together. Done, eliminated. Now what we don't have to do is we don't have to pay our principal and interest. We paid off our mortgage in what, 6-7 years. Okay. Now we could accelerate this also, but I'm using a $500,000 loan, right? I'm using 3.25, so there's variables. So when we get this information, we create a whole strategy and plan. If this is the goal of our members, the goal of a client, right? This may not be everybody's goal. They may want to take that 300,000 and go put it into something else because the 3.25%, it's low interest. So I'd rather take this money and go put another asset and grow another asset. That's fine too. Right? But the tax savings on income is important to understand that if we put that 300,000 into another asset, we have to earn at least a rate of return on that. That would be a return that would make up for that taxable income that we need to pay for our principal and interest. Okay. Now, if we look at this broken down, we have a traditional 30-year loan. This is the mortgage interest. Remember, $283,371.37. Here is the total tax savings, $104,847, assuming the same tax rate for the next 30 years, right? Again, may or may not, right? But I can only use what current rules there are. Now, if we were to pay this down in year 5, the total interest that we would have paid in 5 years was $77,095.68, which was a tax savings of $28,525.40. Then when year 7, we paid this off, we paid an additional interest of $9,341.02 for an additional tax savings of $3,456.18. For a total interest paid $86,000 and total tax savings $31,000, just under $32,000. Now, when we subtract this from the total amount up here, here we go. Our actual savings was $196,000 in interest. We saved $196,934 in interest by paying this off in 7 years. Now, yes, our tax savings is lower but we give up this $72,000 in tax savings. We give this up so we can save this. What would you rather have? Would you rather have $200,000 in tax savings? In interest savings? Or would you rather get this $73,000 in tax savings over the next 23 years? Hello, this is the math, right? This is the math. So your annual income at $41,448 to pay for that mortgage principal and interest at a 37% tax bracket creates a $15,000 tax. Now we can save this and shift this over into other strategies. Okay. So not only are we able to save $15,000 a year, we saved you over close to $200,000 in interest that didn't go to a bank. Now, again, this doesn't necessarily mean that everybody should do this. This is just a strategy or a conversation that says, don't do a mortgage because you're going to save money on taxes, air quotes. Okay. Because that's what every CPA says if you're renting. Ooh, you should go get a house and you can deduct the interest, which is true. You can. Does not necessarily mean it's going to net benefit you. If you're a W-2, you're already going to get that money as an income anyways. Okay. So, and if you're renting, it's just going to go out the door, right? So there's other variables and data points in this dialogue and conversation, which is why I'm not saying I'm making a blanket statement. This is a strategy, or this is something that should be considered for the right type of client. And the numbers should be ran to decide on what decision you make with your money, right? Not somebody else telling you what you should do with your money, what you should be doing with your money, how your money works. So anyways, hopefully this was helpful. I hope this content was great. Give us a thumbs up, put down some comments down there, questions, subscribe if you haven't subscribed, and feel free to share this with your friends. And go ahead and appreciate you guys being a subscriber. If you are, welcome back. And other than that, make it a great day.